Station 51, engine 27, engine 32, truck 105.
You're listening to The Fire Break with Steve Wolf.
Hello and welcome back to The Fire Break, live, as you know. Well, maybe slightly delayed. I'm Steve Wolf. We're sponsored by Team Wildfire, developing innovative technology for wildfire suppression. Check us out on the web at teamwildfire.com. So anybody who's followed any aspect of what's going on in fire knows that it's not just fire, right? That's like the physical thing. But what's going on financially is major crisis and upset and deterioration of the insurance infrastructure and all that's related with that, right? No insurance, no mortgage, no real estate market, no income tax for the states. It's this huge ripple effect. I've got Isaac Espinoza with us today, and Isaac is with Kettle, which you can find on the web at ourkettle.com. And Isaac, you're doing some really interesting work to try to fix what's broken in property insurance. How's that going? And welcome to the show.
Thanks, Steve. Thanks for having me. So pleasure to be here. And definitely, it's been a fun run so far. I've been at the company just under 6 months now as the CEO, but thrilled to be here and thrilled to work on a lot of these problems that we're trying to work on in insurance. So as a quick background on Kettle, the company itself has been around since 2020. And the formation of the company was really off the back of major wildfire events that we saw in 2017 and 2018. And the view was maybe we're looking at this the wrong way. Maybe there's new data sources that we can tap into to try to model this and have a better understanding of the wildfire risk on a more granular level. And as a startup, Kettle was venture backed and was set up to build this model in-house and to use it to provide insurance solutions to various risks. So over time, the model was built and continues to iterate, continues to have improvements and enhancements built on a modern tech stack. We have a very lean team, only 15 people at the company today. About a third of them have a PhD in some sort of science, whether it's computer science, earth sciences, physics, etc. And I'm really proud to be part of this group to try to tackle these problems.
So 2/3 of them don't have a PhD.
Correct, but some of them have some really other fancy degrees. Yeah, right. I am probably the least educated of the group, and I definitely brought the average IQ down when I joined.
I doubt it. Well, although honestly, it wouldn't matter if you did, right? Because as a CEO, your job is to attract and support the best talent you can find, not necessarily be the best talent in the room. So,
yeah, I would agree with that.
Yeah. So, how's that going? And let's talk about this granularity issue. Some insurance companies look and they say, "Oh, you're in California, we're not insuring you." Well, that's about as ungranular as you could be. Some places say, "Okay, you're in California, we'll tolerate that, but you're in this zone that the state has recently redefined, and therefore we won't insure you." When in fact you could be living, on a house in the middle of, 10 acres of concrete, in a bunker, completely fireproof house, but they'll say, "Well, you're in this zone, so you're not insurable." And so kind of takes away, I think, a lot of the incentive for people to do their mitigation, other than, because they want to save their childhood family albums from burning or something. But if you're working to reduce an insurance company's risk, A, you should get coverage, and B, maybe you should get some preferential rate. So
yeah, definitely.
Where are we on all that right now?
Yeah, I think you hit the nail on the head there in terms of the approach that's going on today. I think that a lot of people think about the wildfire risk and view it as something that is non-modelable and too difficult to understand or insure. And it is complex. I mean, it is a risk that's different than many other natural perils in that the majority of them are actually caused by people, either directly or indirectly, or intentional or unintentional, right? It's not all arson. It could be accidentally caused by humans and taken off from there. But as far as our approach to it and the reason why we want to be more granular, it's really, to succeed in the insurance industry, you're going to have losses, but you want to make sure that you're paid appropriately for the risks you take. And the better that you could segment that risk and line up the price to the risk itself, the more successful you're going to be, because there are fewer subsidies that take place and you're competitive across the entire spectrum. So what's going on in the Western US and California specifically, and I know you're in Colorado, that's our second largest state, is that I think a lot of people take a binary approach to wildfire risk where they view something as either wildfire exposed or not. And if it's not, I think they're very competitive there and they want that business because they don't view wildfire as a problem. But if it is wildfire exposed, I think that it needs to be viewed more on a spectrum of how wildfire exposed it is. So if, let's just say, with rough numbers, people think that 40% of the parcels in the state of California are wildfire exposed, the 60th percentile, which is that first of the 40% that they're considering wildfire exposed, is very different than the 99th percentile.
Sure.
And if the market or the insurance industry views it as all bad, don't want to touch it, not going to risk it there,
Right.
and there's a lot of risks out there that, yes, they may be wildfire exposed, but not very much. And therefore, they have an absence of availability of coverage from the market. There are some that are in the 99th percentile that, in our view, with our modeling, there might not be a price that we can charge that's high enough appropriate to the risk if we think something's going to burn every 5 or 10 years.
Sure.
But there are a lot that kind of get cast to the same brush and are viewed as bad as those. And I think that that's an oversight. And companies like ours that can be more refined about, a given property is viewed as 60th, 70th, 80th percentile. Yes, wildfire exposed, but not as much. And therefore, we can probably charge a more competitive price than the market. Now, on the other side, too, though, I mentioned, let's say if we drew the line at the 60th percentile, and if it's binary treatment, it doesn't mean those that are non-wildfire exposed aren't wildfire exposed at all. Even some of those,
Right.
they remap where the wildfire territories are. And you may find that some of the insurers have found that stuff they thought wasn't wildfire exposed actually got hit. So really, it's, instead of a binary approach, I think it's a continuous distribution. And I think that the insurance industry should approach it that way. And the closer you can match price to risk, the better off you'll be.
Yeah, I would imagine that with the amount of regulation and barriers to entry to becoming an insurance company, you had quite an uphill battle just getting to where you are.
Yes, that absolutely plays a role too. And some of the talk about, the advancements of wildfire models, there's many times restrictions about the ability to use those models, right? So there are large carriers out there that have models they would like to use, but they can't necessarily take those outputs and translate them directly into the pricing because there may be restrictions on the regulatory side that prevent them from being able to be more dynamic with their pricing. And one thing that I would say that has been happening in certain states is that inflation has happened significantly over the last number of years, as have expectations or estimates around the frequency and severity of perils like wildfire. And if you can't charge an appropriate rate or an actuarially sound rate to meet that growing risk and that growing cost, then your only other alternative is to just stop writing business there. And so that's what's been happening over the past number of years. I think there are a number of compromises that are taking place of like, hey, we'll let you take a rate increase, but then you have to write more in wildfire exposed areas. But it's not truly an open market. And so there are some limitations that I would say some of the larger carriers that have been around longer that want to use the latest and greatest models may be somewhat limited on.
And who's restricting that use of data?
Well, it's something that there are two different types of markets in the insurance industry. There's what we call the admitted market and the non-admitted market. In the admitted market, you would need to file your rates, forms, and rules on your insurance product with the state regulators. And it would be those state regulators that have some back and forth and make sure that the rates you're filing are actuarially sound. And but sometimes there are other forces at play, consumer rights groups and others that say, hey, you can't charge too much, you need to keep the price down, or maybe there's some other limitations. But I would say there's different levels of involvement from state insurance regulators. And if they are more involved, then the insurers may find that they're more restrictive in terms of their ability to increase or decrease rates or respond to market conditions.
So you think that it's regulatory inhibition that's responsible for what most people just see as inaction or inertia on the part of big companies? Like is it legitimate to say, oh, they would be changing as fast as they could, but the regulators are standing in their way? Or are they just, enormous entrenched companies that do things the way they've always done and maybe have some opportunity to change, but it's hard to get change, at scale in such a big organization.
I would say all of those are actually contributing factors. I wouldn't point to one single answer to that, right? So
Yeah.
there are massive companies that are entrenched and they're not going to move their book around significantly from one year to the next. It's
Right.
just, it would be too disruptive and they're not necessarily set up that way. But some of the changes that are going on today, in terms of if you watch any of the news about State Farm, they're pushing for increases while regulators are negotiating that with them. So that's an example of a little bit of the actions that some insurers are wanting to take, and then the responses that the regulators have. But that's one thing that contributes. Another is that if there's some new technology or some new home hardening methods or something along those lines that relate to mitigation, if someone does something like that that's going to result in reduced expected losses, the expectation is my premium should drop for that too, right? But if you're in the admitted market and you want to give someone a discount, often you have to have some proof with historical data to show why that method or that technique or whatever it is that you're doing is resulting in reduced losses or expects to result in reduced losses. And in many cases, those types of debits or credits would also need to be approved before they can be charged in the market. Where we play is in the non-admitted market, and some people view it as maybe a market of last resort or an area where there's more niche product offerings. We participate in the what's called excess and surplus or non-admitted market, and in that market where you have this protection gap that exists, where insureds are trying to find coverage, maybe they can't find it through the normal admitted market channels, that they would go to a company like us and meet that need. So some of the products we sell are actually wildfire only in nature, and they may be parametric. So what that just means is that instead of the traditional insurance product where you're being compensated on an indemnity basis, meaning how much money did you lose, therefore what is my claim that I pay you for? Ours is more triggered by mathematical formulas and an occurrence triggering a rule. It's effectively, if for example, we have a product that we call FIP, F-I-P, or fire in parcel. And effectively what that does is it takes a look at all the footprints of wildfires across the country. And it also sees if any wildfires intersect with the parcels of the properties that we're insuring. And if it does, it meets the trigger that on a parametric side that it would result in a payout. It is from there that our policyholders have the ability to file a claim within 60 days. And it has to have a minimum of $10,000 of loss so that it's not considered a derivative product.
Right.
And from there, we receive the claim form and pay our claims within 10 days. So it does have what's called basis risk, which means maybe you have the wildfire enter the property but not destroy it, or maybe you have a neighboring. That's a basis risk in one direction.
Okay.
Or you can have basis risk in the other direction where the wildfire doesn't actually enter the property, but maybe there's some smoke damage from burning a neighboring property.
Sure.
In that case, our product wouldn't pay out. So that would be the basis risk in either direction. But the benefits of something that's parametric is that it's simple. The rules are stated up front. The amount of coverage is stated up front. The premium stated up front.
Right.
And then the claims are quickly paid. So, for example, we don't have any open claims remaining from the January events, which I think a lot of other insurers can't really say. There will likely be claims open for years to come.
Sure. And tell me about loss in value rather than actual property loss. In Colorado, there's a lot of people who have multi-million-dollar homes that are valued the way they are because of the view. Right? I'm looking out over a landscape, thousands of acres of pristine forest, and now, and so I can command X dollars, for the value of my property. And now I'm looking out at this huge burn scar that's, accompanied with little dots of landslide. Right. This is no longer the $1 million view. Now, let's say I can only get $1 million less. So I've suffered a loss in the value of my property. How would someone go about covering that?
Yeah, to date, the aesthetics of things like a view or what your neighboring surroundings look like wouldn't necessarily be factored into a claim, because when you're buying an insurance policy for a property, you're insuring the property more so than insuring the land or the use of that land. There are some things that you can be compensated that maybe as on the commercial side, let's say you have business interruption, where you can be compensated for the loss of income there if you're not making as much money as a result of the event, or you can't run your restaurant or run your shop
Right.
as a result of the event and the property burning down. But very, very different in terms of insured values versus market values of a property, because the land is the piece that's not effectively the insured piece. It's the structures and the contents. So, but the other thing that is going to impact for valuation or loss of value is if I always think about when people purchase properties, they think about it not on the actual sticker cost. It's what is the affordability of that property? What is your monthly payment on a mortgage?
Right.
And your monthly payment is not just the mortgage, it's also your taxes, it's also your insurance cost. So
Right.
you may find that if you own a property that is in a high wildfire exposed area, the affordability of that property is reduced, because if you end up having increased insurance premiums, not only are you paying your mortgage payment, you also now have to pay more for insurance, which means if I was expecting to pay $5,000 or $2,000 a month for said property, if a greater portion of that budget that I have is now going toward insurance rather than paying off my loan, then that translates to the valuation of the property going down.
Sure.
So I think you will probably find a bit of that if the affordability of a property is more difficult, then the value of it will also go down, because people make purchases based on what they can afford, not necessarily based on purely what the value is. And I could say I experienced that where I live. I'm in Grand Cayman, which is just south of Cuba, and we're in an area that's in a prime zone for where hurricanes can hit. And the insurance cost has always been quite expensive, and in recent times it actually has gotten even more expensive. Utilities have also gone up in cost. So when people think about the ability to afford a property here, they have to factor in all those items, not just the cost of the purchase and paying that off. So if our insurance goes up and our utility costs go up, that likely means that our property values go down, because if the affordability is X thousand dollars per month,
Right.
and it's being allocated to other expenses, then the valuation, I think, would take the hit.
I'm sure. Where are you guys on market share right now? And
Oh,
on growth compared to where you were a few years ago?
yeah, so we're still fairly young. On market share, we're quite small, depending on what you consider to be the market. But if I were to look at the property insurance market in California, that's between homeowners and commercial properties. In 2025, that'll probably be just under $30 billion of premium.
Okay.
And our market size, or our portfolio size, is end of the year we closed it close to $20 million of premium. So I guess in that calculation it would be less than was that 0.1%, 20 million on a $30 billion market.
Right.
But we are growing at a good rate, and just a couple of years ago we wrote our first $1 million of premium. So in 2022 we were right around 1 million, and then we closed the 2024 pretty close to 20 million. So our expectations are
Great growth.
we expect to continue to grow, not necessarily 5 or 10x a year, but there is a lot of opportunity out there to write more business, and if we can price it appropriately to get the appropriate margin that we expect for the risk we're taking, then we will continue to grow.
And how do you get the word out? I mean, how does somebody find you? Because it was only, I've looked at this market pretty extensively over the years, and it wasn't until
Mm-hmm.
somebody said, "Oh, have you thought about talking to the folks at Kettle? They do that'd be
Mm-hmm.
interesting." And I'm like, "Who's Kettle?" Um,
Yeah.
right. So I'm
Well,
sure that's. I'm not saying anything you hadn't heard, right? But
yeah, yeah.
yeah,
Well, maybe you can help
hey,
help
what
get
I
the
would
word
love
out
to.
on this podcast here. But
Yeah.
additionally, one thing that's a little bit different in terms of how we market, we view our differentiator being our ability to model and price and underwrite risks that are wildfire exposed. And because we're operating in the commercial insurance space, it's less about the brand, it's less about the marketing. Our customers that we're working very closely with are our distribution partners. We ourselves are not distributing and knocking on doors and sending emails and going, from property to property. We have a very strong network of wholesale insurance brokers and retail brokers that we work with that come to us when they have a need to try to solve difficult to place insurance risks. So unlike where I previously came from, where we were selling auto insurance and the brand was more important, people, they see all the jingles for different companies, and the marketing spend on companies like Progressive and Geico. I think Progressive last year spent $4 billion on marketing alone.
Wow.
We are not in the personal line space, and so it's not necessarily a high budget item, but we could pass on those savings to our customers by having a lower expense base.
Sure. So your brokers essentially, and
Mhm.
these brokers are carrying options from many companies.
Yeah, so the brokers do represent multiple insurers, and so we're not the only one they would go to. But I would say the main scenarios where the brokers are coming to us is, let's say that you have a broker that places insurance for a winery, for example, and that winery has crops, it has employees, it has vehicles, it has buildings, and wineries tend to be, especially in California, in some wildfire exposed areas. So if, say, that insurance broker is placing all these things pretty easily, but then they're saying, oh, but it's hard to insure your property because it's wildfire exposed, and I can't. The insurers I usually work with on this type of thing are they have no appetite for this type of risk. It would be then that they pair up with their wholesale insurance brokers that have more of that niche expertise for these unique products, and then it would be from there that they would reach out to us and provide the information around the property, and we would evaluate it and come up with a price, and then ultimately decide if that's something that they want to move forward with or not.
Or self-insure.
Or self-insure, yeah.
Eat
And
their
in many
loss.
cases, though,
Yeah.
self-insurance is if you own a property outright, that makes
Yeah.
sense. But
Right.
very rarely, if there are liens out or something where you're borrowing, that would your lender ever
Yeah.
allow potential for a wildfire risk and no recovery?
And this is more a generic question, but what happens if you have a mortgage, you have proper coverage, and then your coverage gets dropped and you can't get new coverage? What happens to your loan?
That's a good question. If you're referring to some of the news that I think I heard around the time that the wildfires were happening, I heard about different insurers getting a lot of bad press because they were non-renewing customers. I would say that's potentially a misunderstanding in terms of what was happening. I think that I've even heard some situations where, like, I'm in a car and the Uber driver when I'm in California is saying, "Oh, the insurers are canceling people while their house is on fire." I'm like, it's not exactly that's
Yeah.
happening. What happens is if the insurers cannot get the rates that they need to charge for a risk, they may, with notice,
That's
provide
right.
a
Yeah.
non-renewal
That's
notice. And
right.
it would be in those situations that at their renewal, they would tell them, hey, we're not going to be covering your property at renewal because it's too risky and we can't charge enough for it or whatever.
Right.
It would be in that situation that insured would then be with notice,
Yeah.
look for alternatives. And in the market today, California specifically, there aren't many carriers out there writing new policies. There are a few that are growing quite a bit in this market. But there's also something called the FAIR Plan, which people can go to place their risk. And it may have more limited coverage, but it would allow them to have continuation of coverage, given that they probably live in a more wildfire exposed area. And so they could have coverage there. And it probably would be the requirement of whoever their lender is
Yeah.
that they have to maintain coverage, or potentially they are in breach of the covenants of that loan and would be in default. So it's very important that they have that continuation of coverage, and the banks aren't going to, or the lenders aren't going to want to have to take on that risk.
Right. So would lenders be a potential market for you, where if the homeowner doesn't um, conform to the insurance requirements that the lender has, that the lender then
Mm-hmm.
has the option to purchase coverage and add that to your
Mm-hmm.
monthly bill?
Yes, potentially a lender could buy it on behalf of a portfolio, and I would assume in that situation they would be passing along the cost to
Sure.
um, who's borrowing. But there is something in the market today that a lot of people aren't maybe aware of, and that is if you look at earthquake as a risk. In a typical homeowner's policy in California, earthquake is not covered as part of your homeowner's policy. And so you have the ability to buy a separate earthquake policy, but
Yes.
very few people actually do because it's quite expensive and it usually does have a pretty high deductible. So I can't remember the exact numbers, but I believe
Yeah.
the take up rate is like 10 or 20%, which means that 8 or 9 out of 10 properties in California don't have earthquake risk. Now, we haven't had any major earthquakes, and I hope we don't for a long, long time. But the homeowner's policy does cover fire following an earthquake, but it doesn't cover earthquake itself. So if we find ourselves in a difficult situation where we had a major earthquake that doesn't cause fire, there probably will be a lot of properties that are effectively uninsured or underinsured
Yeah.
following an earthquake event. And I don't know if wildfire will go that route too, but in the insurance industry, flood and earthquake tend to be two that are outside of a typical homeowner insurance policy.
Right. And yeah, a terrorism exclusion, etc. Right. Um,
Yeah, there's usually cyber terror. There's various other exclusions. Yeah, you're right.
right.
Yeah.
So I would imagine, besides the cost
Mm-hmm.
for earthquake coverage, one reason people might not purchase it would be like, well, if there's a disaster on that scale, FEMA's going to come in and I'm going to get my check and rebuild my house. And, as of now, that's looking like a pretty poor bet.
Yeah, I don't know if I would put all my money on that.
Yeah.
I think I'm fairly risk averse, so my preference is to have protection from extreme scenarios, and really that's why insurance exists, right? It's
Right.
effectively a subsidy where you can pool money together to come to the table for some that experience very difficult times. In fact, I mean, no matter what insurance line of business you're in, having a claim is usually not a pleasant situation. And so it's nice to know that you can be taken care of with the insurance you have in place. And I think for all of those that don't have claims, I know there's many people that may say, hey, I never had any claims. Why is my premium so expensive? But I don't think any of those people would prefer to have a claim so
Right.
that they can make their policy, worth their while. It's an interesting product because you're selling a promise, and no one really knows what the ultimate cost will be. So you're selling a product and you don't yet know what the cost is. But when that time comes, you hope that you're going to be taken care of, given that you've been paying your premiums historically, and you want your insurer to reciprocate in a time of need.
Right. And you hope that you're not underinsured, because
Yep.
the house that you thought was going to cost $1 million to rebuild, now you might be facing tariffs on imported lumber, etc. And now costs 1.3 million, and you're out 300 grand.
Yeah, it's a good point you raised that, and that was a concern I mentioned in some other interviews when the wildfires were happening. I do believe that there is going to be a fair bit of uninsurance, but probably even more underinsurance that took place from the recent events that happened in January. There's something called insurance to value, and you're meant to keep up your insured values with the inflation. So if you're insuring for $500,000 and your replacement cost of your home the following year is 550,000. I don't know if everybody's necessarily increasing their coverage every year in line with this inflation. And if you find that inflation has surpassed the levels of coverage you've been maintaining, you could find yourself in a situation where your insurance policy only partially pays for your claim because you were only partially covered effectively.
Yeah, right. And it's probably easier to find out a change in the value of your home. You can ask a realtor, and they'll do the
Mhm.
comps, and then here you go. But it's probably more difficult to figure out what the replacement cost is going to be.
Absolutely. Yeah. I think market values, and that's an important thing. Market values are not the same as replacement costs, but you're more thinking about the materials when you think about replacement costs, cost of
Yeah.
labor, cost of materials, and all that. And you're right. I mean, with the uncertainty around tariffs and potential labor costs, people may have thought they were fully covered or had enough in funding to be able to rebuild, but maybe find that that's potentially coming up short.
So could there be options? Probably not, according to the lenders. But I'm wondering if you could purchase your wildfire coverage separately than your other coverages. There's just the way you're required to do an earthquake, to have that option, and then the company that's providing the wildfire insurance could really provide a granular level uh, pricing based on the level of mitigation that the homeowner does.
Yeah, actually, that's what's taking place now with us. For example, most of the policies we sell are wildfire only, and so think of a condo complex, for example, that they have a lot of coverages and a lot of things they need to consider. But if their insurance policy has limitations around the wildfire risk, say that insurer is happy to cover the condo complex but doesn't want the wildfire risk, they may
Right.
have what's called a wildfire exclusion, or they may have a big wildfire deductible saying, okay, if you get hit with wildfire, you pay the first $1 million. Or they
Right.
may have a sublimit that says, hey, I know you're a $10 million property of condos, but if you have a wildfire, I'm only paying $1 million. The next 9 is on you. It would be in that situation that the purchasers of insurance would go to their brokers and they would find us, and we could potentially sell them a cover that fills that gap.
Or they could delete wildfire coverage from their primary policy, which would drive it down to supposedly the same level that it would be no matter where the property were, and
Mm-hmm.
then purchase what I would call discount or appropriately priced
Mm-hmm.
coverage based on how you decide the mitigation efforts and the construction materials, et cetera, add up.
Yeah, it's a very different profile of claim that happens on our book versus other types of claims. So if you think about, may have a property that has a kitchen fire or theft or a pipe burst or something like that.
Right.
Those claims tend to be smaller in size and they're underwritten a different way. But on our side, if we're covering strictly wildfire, then we can rely on our modeling and our expertise in that area and our awareness and knowledge about the property's mitigation features or hardening features that can help us refine our price. So yeah, it's possible that down the road it becomes more clear cut that there's a wildfire component and a non-wildfire. I would just say the downside to that is if it went the way of earthquake and
Yeah.
the take up rate of a wildfire only policy is 10 or 20%, then you still have a significant issue in the
Unless
event
it's
of a wildfire,
mandated by the lender.
unless it's mandated by the lender. But in an earthquake, I don't believe it is. That's why the take up rate's as low as it is.
I see. Well,
Yeah.
that may change, right? If FEMA goes the way it looks like it's going, then lenders may require that coverage be bound.
Yeah, possibly. And I've done some different types of insurance in the past. I've worked in insurance and reinsurance. So reinsurance is just insurance for insurance companies, and we have supported mortgage insurance as well as a reinsurer. And I would say one of the biggest risks on that portfolio was the example of a California earthquake, where you have people that potentially have their homes destroyed. They still have a balance on their mortgage. Now they're
Right.
significantly underwater, and therefore there's a default with very little to recover.
That sounds like a terrible situation.
Yes,
You talked about
absolutely.
the data and the models that you use. Are these internal models, or are you looking at programs like Athena Intelligence that are providing, parcel level risk evaluation?
We use a number of data sources, both public and private. So we do license some data sources out, and we also access various public data sources. We use over 50 in total different data sources, and
Wow.
I would say a big process for what we do is to take all this data in different forms and be able to figure out the ways to pull it in all together and run models on that, right? So
Yeah.
let's say you may take real estate data of here, satellite data, weather data, topographic data, and they come in all different shapes and sizes and forms. And to be able to map it, it is a huge data engineering exercise. But once you get it to a good level on a granular basis, you can run some pretty sophisticated models to come up with prediction. And when we think about what we're doing at Kettle, we model the hazard, which consists of two components, two main modules. First is the ignition, which is where does this wildfire start? And there's a number of contributing variables that drive where a ignition happens. And I mentioned earlier that humans cause the majority of ignitions or wildfires, and that's in many cases unintentional. But regardless, proximity to roads and power lines and civilization and campsites all contribute to where a wildfire could start. But it also could be lightning or something else naturally, right?
Sure.
But what we look at is the ignition, and we have heat charts throughout the country to show where ignitions are more likely to happen. But then on top of that, I mean, you may have 10,000 ignitions a year in the state of California alone. So there's a lot of happen that don't
Yeah.
eventually develop into anything. But another major component is what we call our spread model. Given an ignition and given the surrounding conditions and terrain and vegetation, what is the probability of a wildfire then becoming a wildfire and spreading, and how would it spread? And if you look at the events that happened in January, the wildfires, we would view that largely as a wind event because it was an ignition and it was a fire, but it was these really strong winds that the embers were traveling miles, which makes it extremely difficult to contain. And then if you add to it that you can't provide air support because of the speed of the winds, it really was, everything that could go wrong kind of did, right? And so when we model out wildfire, we look at a very detailed level about the ignition. Then we look at the hazard, ignition and then the spread. And then the next component, given that you have your data set of synthetic, we call them synthetic wildfires. They're effectively wildfires we generated for modeling purposes. Then you look at vulnerability. So that would be more looking at the community features about potential mitigation measures that were taking place, surrounding vegetation and construction type and all those things. Those play a role too, that given a property gets hit by a fire, how well does it hold up? And unfortunately, with wildfires, it's probably one of the most devastating perils out there in terms of the amount of destruction it causes. If you were to compare it to hailstorms, floods can be very extreme too, depending on the condition. But windstorm, believe it or not, is not nearly as bad on the severity side per property. When you think about a hurricane, a direct hit, yes, is very bad. If you're on the coast and you have storm surge, yes, very bad. But in many cases, it's certain, things blown off the roof or debris or various like that. It's not as common that it just, blown away entirely, like maybe a tornado would do, or a wildfire.
Yeah, I would like to see more overlap between military tech and civilian firefighting tech, because I've never seen a circumstance where, the general said, we need you to bomb this spot right now. And the pilot say, oh, sorry, it's over 30 miles an hour. We can't do it.
Yeah. Well, I mean, safety is important. Yeah.
Yeah.
Safety is important, but I would say that in terms of like the response to wildfires, and I think it is the right order, the first 12 to 24 hours relate to saving human life, right?
Yep.
So protecting humans first and foremost, minimizing casualties there. And then following that, there's a focus more on the property. So one thing I'd like us to get to at Kettle is to be able to publicly share our spread models so that people have access to them and they have an understanding of what the relative risk is of given properties in given areas. And maybe that could even play a role in the defense of the wildfires. So if you're thinking about the relative values of properties exposed, maybe there's a certain prioritization that can take place based on what we know from our models in terms of how this is expected to spread and how to potentially best defend it. You've seen this for just about anything else. If you look at a hurricane, they have a cone that shows the expected path and the number of models that show the speed it's traveling and the strength of the storm and the pressure and the magnitude of it. But we haven't really seen too much about that on the wildfire side. It's publicly available, and like I said, I'd like us to be able to use those models for public good. And if we feel we have something in the science of our models that can be helpful, then we definitely should be wanting to share that with public resources to try to defend these.
Sure. How much range is there within comparative spread models? If I put an XY ignition point on your map, and then I do the same thing on Aurora Techs, and I do the same thing on Technosilvas, and I do the same thing on, SimTable and what other mapping things. How close are they?
That's a great question. I'm guessing there's going to be a wide variance between all of them, and there's a ton of models out there. And I think a number of people were surprised by the events that happened in January because they spread quite a bit beyond the urban interface, the WUI, right?
Yeah.
And they've gone, burned property to property, effectively taking out entire urban areas. I would say in our modeling, we do have events that are in our event set that were even bigger than the fires that we saw in Palisade and Eaton. And, so in other words, the footprint of a synthetic wildfire that we simulated
Yeah.
has gone multiples the size. So, and that's important to have
Yes.
because, even though it's considered rare, it is a possibility. And if you want to think about what we call a tail scenario, maybe something you haven't seen yet, but is still in the realm of possibility, you need to have those tail scenarios. Otherwise, if you assume that certain areas will never get hit in all your possible wildfires, and then they get hit, there's something wrong with your model. And
Right.
I think a lot of the other models have things like that out there. And I would say that in general, all the models are moving the right direction, just with the abundance of data and the advancements of science and modeling techniques. But it's not going to be perfect. And I would say that in our case, we probably had a more bearish view of the areas that were impacted,
Yeah,
and
that's
therefore
good.
we didn't convert as much on our policies. Like we have a number of quotes and indications of selling insurance, but in many of those places, there were people that were probably much more aggressive in terms of their pricing, and therefore our hit ratio wasn't as high in the impacted areas because I think our models show those areas as being relatively high risk.
That's very interesting.
Yeah.
And I would imagine for a public safety agency,
Mhm.
they're going to do better by planning around the worst case model than the one they happen to subscribe to. And by
Yeah, you
subscribe,
kind of
I
always
mean,
have to.
a paid
Yeah,
subscription.
yeah. Prepare for the worst, hope for the best. I mean,
Yeah.
yeah, and there's always going to be things that are not contemplated in no model is perfect, right? It's kind
Sure.
of garbage in, garbage out. But you want to do as best as you can with these tools to try to assess what you think the relative risk is of something. But just throughout time, people have been doing models for all kinds of natural perils.
Yeah.
There's always things you learn that can happen that you didn't really contemplate in the model, and then you add them
Right.
to it. I wouldn't say that in our case, with the events we've had this most recent wildfire season, that really anything's changing too much to our model.
Right.
It really just more reiterates the way we've gone about it as being pretty consistent or pretty accurate. But we are striving to always improve, and we are looking at new data sources and new techniques to try to get to the right answer as much as possible. And fortunately, there aren't so many major events that we're not continuously able to backtest
Right.
comparing it. But if you look at the past couple decades, 18 of the worst 20 wildfire events we've experienced were all in the past 2 decades.
Yep.
And the 2017 and 2018 years were the worst up till recently. And now what we had in 2025 in January is multiples the size of that. So there definitely is a trend of increasing frequency and severity, but there is also evolution of like there is development happening in a lot of these are desirable places in many cases to build, but also more vulnerable to wildfire risk.
You have to just love the adventure if you want to live there.
Yeah, and
But
I
the
would say it's
adventure might
similar in the
mean you're
coast.
evacuating, you know?
Yes, yes, and
Yeah.
and the coast of Florida is a good example of that too, right? I mean,
Yeah.
I think I heard a stat that when Hurricane Andrew hit, you know, 30 plus years ago, that the losses from Hurricane Andrew, which hit just south of Miami and Homestead, the losses from that event, and I think this is true, were larger than all premium dollars collected in the state of Florida since the beginning of time.
Wow.
Now, there
Wow.
is a play on that there wasn't as much development. Florida was a later developing state, so
Yeah.
I don't think that many people actually lived there before the '60s. But that is pretty shocking to think that you could have an event that costs more than all the premiums collected in that state.
Yeah. That's
And it really, I would say, was what triggered a lot of the modeling that's out there today. The formation of AIR, Applied Insurance Research,
yeah.
that company was, I believe, formed out of that one or Hugo, because they felt, hey, we need to be on top of this risk and model it out, and it has a huge implication on insurance and reinsurance. And there have been a number of other modeling firms that have been set up since then, but that's a shocking stat, and I just bring that one up because if this one was an insured loss of, call it, $50 billion, I mentioned that the entire property insurance industry in California is probably going to be less than $30 billion of premium. So imagine having an event in 1 month that already costs you nearly twice all the premium you're expected to collect throughout the rest of the year, without even considering the expenses associated with that insurance and any other claims you would have in the remaining 11 months.
Fascinating times, huh?
Yeah.
Right. Isaac, I want to thank you so much for sharing your insight into what is such a complex and vital aspect of America's financial life. Really interesting.
Thank you so much for the opportunity, Steve.
Absolutely. We've been chatting with Isaac Espinoza from Kettle, which you can find online at ourkettle.com, which you'll probably be looking at, more if you're a broker than a consumer. But if you want to go on there and figure out how to play with the modeling, that's either available or coming soon at the consumer level. So check that out. Thanks for listening here on the Fire Break or watching. I'm Steve Wolf. We're sponsored by Team Wildfire. Thanks so much. We'll see you at the next one.